When you're flying a plane, particularly in really bad weather, there is this terrifying phenomenon called spatial disorientation. Like your inner ear, your physical senses, they completely tell you that you are flying perfectly level.
Right. It feels totally fine.
Exactly. It feels completely fine. But then, when you actually look at the instrument panel, the dials are just screaming that you're in a steep, dangerous dive.
It's this profound cognitive dissonance. I mean, your body's telling you one thing, but the math, the actual physical reality is telling you something completely different. And you have to make a split-second choice about what you're going to trust.
Right. And if you trust your feelings over those instruments, you crash. And looking at this incredibly detailed strategy dispatch we have today from Sovereign Dispatcher, dated April 29th, 2026, that exact same spatial disorientation is happening in the global financial markets right now.
Yeah, the feeling in the cabin is pure euphoria, honestly.
It really is. I mean, markets are hitting all-time highs, and it's largely driven by this incredible optimism around artificial intelligence.
The feeling is definitely that we are cruising at 30,000 feet, clear skies ahead, and, AI monetization is just going to smooth out any turbulence.
But the instruments are flashing bright red. We are talking about severe warnings in global energy flows, in emerging markets, and in the underlying plumbing of global currencies. So whether you are managing investments or running a business, or you're just trying to understand how global events actually impact the economy around you, navigating this deep dive is basically a masterclass in reading the instruments instead of, just trusting the feeling.
Well said. And I think the most revealing part of the dispatch is how it isolates this massive contradiction that's playing out in real time. It really highlights how heavily filtered the headline consensus has become.
Let's unpack that contradiction right away, because this is probably the most actionable signal of the week. We can call it the tale of two desks. But this comes straight from Bank of America's internal research that they published on April 26th.
Yeah, this is fascinating.
You literally have two different divisions within the exact same bank publishing entirely incompatible views on the exact same day.
Right. So on one side, you have the chief investment office, the equity desk. And they are just overwhelmingly positive. I mean, they are telling clients to heavily overweight U.S. equities, pointing to this massive resilience of the U.S. economy. They actually note the U.S. has added $9.2 trillion to nominal GDP since 2020.
Wow. So their entire thesis is just that AI is generating so much value so quickly that the market can literally just absorb any geopolitical shocks. That's the flying level feeling, right?
Exactly. But then literally down the hall, you have Bank of America's Global Economics Desk, which is led by Claudio Irigoyen. And they publish a formal economic model treating the ongoing Iran conflict not as, a passing headline, but as a dynamic game.
Wait, let me stop you there, because for those of us who don't model game theory all day, what actually makes this a dynamic game as opposed to just a regular geopolitical conflict? Is it just like the rules change over time?
Sort of. So in a static game, both sides make a move, they absorb the cost, and it's basically over. But in a dynamic game, the players are constantly adapting, and the costs and the payoffs, they compound over time.
I'll let you see.
Yeah. And Irigoyen's explicit conclusion from this model is that the equilibrium of this war, basically the state where neither side has an incentive to change their behavior that can last much longer than what the market is pricing in right now, time actually increases Iran's deterrence benefits.
Okay, let me guess the mechanism there. If Iran engages in a prolonged blockade or like a low-level conflict, the financial and military costs for the U.S. and Israel to maintain this high-alert defensive posture are just astronomical. But Iran's marginal military spending remains pretty low.
That is exactly the core of it. I mean, sending a drone costs a few $1,000s. Firing a sophisticated interceptor missile to shoot that drone down, that costs millions. So over time, that asymmetry just bleeds the opponent's resources and their political will. Irigoyen's model basically concludes that because of this dynamic, no party has experienced enough structural pain to capitulate yet. So the war runs longer.
It is exactly like going to the same hospital and seeing two different specialists.
Yeah.
Like one looks at your chart, sees you've gained some muscle, and says, hey, you are in the best shape of your life, go run a marathon.
Right.
But the other specialist runs a deep blood test and says, you have a chronic, prolonged condition that is slowly draining your entire system. And the fascinating and, frankly, kind of scary part is that the market is only listening to the doctor telling them to run the marathon. They're entirely pricing in the view of the equity desk.
which, happens to be the desk that benefits from the fee revenue of people trading stocks.
Oh, yeah. Always follow money.
Exactly. The rigorous mathematical model from the economics desk is basically treated as interesting background reading, but it isn't moving capital.
I have to push back a little bit here, though, because if you turn on the news right now, the big headline driving all this market optimism is that there is a ceasefire in place. I mean, I am looking at headlines that say the conflict is paused. If the bullets stop flying, shouldn't ships start sailing again? Like, why is the economics desk so pessimistic if they've called a timeout?
Well, the dispatch actually addresses this directly by contrasting political headlines with physical reality. And the most consequential number in this week's data comes from Goldman Sachs.
Okay.
Despite the political ceasefire, estimated physical oil flows from the Persian Gulf, and this includes all the pipeline redirections, they are only operating at 40% of normal levels.
Wait, 40%, meaning 60% of that critical energy supply is still offline.
Yes.
But why? I mean, if there is a ceasefire, why aren't the tankers moving?
Because the tanker company isn't going to risk a $150 million vessel and its crew just because two politicians agreed to a temporary pause in escalation.
Oh, right, insurance.
Exactly. Insurance premiums for traversing those waters remain prohibitively high right now. The underlying risk architecture just hasn't changed. The source really emphasizes that the market saw the word ceasefire and immediately priced in resolution.
Right, but a pause does not magically restore structural supply disruptions.
No, it doesn't.
And the pricing data completely backs up the physical reality, even if the stock market doesn't want to admit it. If you look at the commodities instruments, WTI crude bounced 12.6% in a single week to $94.40. Brent crude is sitting at $105.33.
Yeah, that's a massive move.
Right. That price action completely erased any dip that occurred when the ceasefire was announced. The physical market is screaming that the oil isn't flowing.
And for an asset class that cares about sovereign solvency, meaning whether entire countries can afford to keep their economies running, a 40% flow normalization is not just some footnote, it is the central variable. Plus, oil on water buffers, which is basically the emergency supply of oil currently in transit on ships, those are approaching all-time lows.
Oh, wow.
Yeah, there is literally no cushion left.
Which means these high oil prices aren't just abstract numbers ticking across a screen on Wall Street. They act as a physical wrecking ball for countries that rely on importing their energy. And the dispatch gives us a perfect real-world case study of this domino effect, which is India.
Yeah, Goldman Sachs identified a really critical threshold for India's economy here. They noted that Brent crude rising above $100 a barrel is basically the trigger point where India's food inflation rapidly accelerates.
Right, because energy costs are the hidden variable in all food production. Like, it costs more to run the tractors, more to produce the petroleum-based fertilizers, more to truck the grain to the market.
But why is food inflation specifically such a dangerous tripwire for India's central bank?
Well, in a developing nation of over 1 billion people, food inflation isn't just an economic metric. It is an immediate socioeconomic crisis. I mean, when basic sustenance becomes unaffordable, the Reserve Bank of India, the RBI, they can no longer maintain a dovish, economy-stimulating stance.
They have to act. Exactly. They are forced to hike interest rates to cool down prices, which then slows down their entire growth engine. And with Brent at $105.33, that $100 tripwire is already in the rearview mirror.
And the dispatch goes even deeper into this, highlighting what they call a compound shock. Because an economy rarely breaks from just one thing, right? It's usually a combination of failures.
Yeah. For example, the International Monetary Fund recently conducted their baseline models for India, their Article 4 assessment, and they projected a highly manageable current account deficit of about 1.9% of GDP.
Just to make sure we're grounded here for everyone listening, a current account deficit is basically a country's checking account balance with the rest of the world, right? It means India imports more goods and services than it exports.
Correct. And a 1.9% deficit is very sustainable for a growing economy like India. But the IMF built that model assuming a much lower trajectory for energy prices. They assumed, $80 or $85 oil.
Oh, I see where this is going.
Right. At $195 oil, India's import bill just skyrockets, and that 1.9% projection is suddenly completely obsolete.
And on top of that broken assumption, independent meteorological forecasts came out this week predicting a severely weak monsoon season for India. And for an economy so heavily dependent on agriculture, a weak monsoon directly impacts crop yields, which drives food prices up even further, completely independent of the oil shock.
It really is an economic perfect storm. The IMF modeled the energy shock and the weather shock as separate, low-probability events. What they didn't do is stress test the Indian economy against both of them happening simultaneously.
It's like testing an umbrella. Like, the IMF tested India's economic umbrella against a heavy rainstorm, and they tested it in a wind tunnel. But they never actually tested it against a hurricane where the wind and the rain are hitting at the exact same time.
That's a great way to put it. Now, to be fair to the source material, the dispatch does point out some major silver linings. India has built a much stronger umbrella than they used to have. They are not in the fragile position they were in during the 2013 taper tantrum.
Remind me about the taper tantrum. That was when the U.S. Federal Reserve hinted they were going to stop pumping money into the economy. And investors kind of panicked and pulled their capital out of emerging markets, right?
Yes, exactly. In 2013, just the mere hint of tighter U.S. policy caused a massive capital flight. And India's currency plummeted because they don't have enough foreign reserves to defend it.
Right.
But today, it's a completely different story. Their foreign reserves are up to $697 billion, compared to just $304 billion back then. Their import cover, which means how many months they can survive on imports using just cash on hand, that's 11 months instead of 7.
So structurally, they are prepared. They can actually weather the storm.
They can likely survive it without a total systemic collapse, yes. But the critical blind spot the dispatch points out is how the market is behaving right now. Market spreads, specifically the yield premium investors demand to hold Indian debt over safe haven assets, usually measured in basis points. Those haven't widened at all.
Not at all.
Nope. And a basis point is just 0.01%. But the fact that these spreads haven't moved an inch means the market isn't pricing in this compound stress test whatsoever. The market is pricing India's bonds as if the hurricane doesn't even exist.
Which brings us from the highly visible world of commodity shocks,
Yeah.
Oil prices, agricultural yields, monsoon rains, to an invisible silent financial threat that is accumulating in the background. The yen carry trade. And I know this sounds like pure Wall Street jargon, but it is actually the structural leverage propping up a massive portion of this market euphoria.
It really is. And the mechanics of a carry trade are remarkably simple, but the sheer scale of it makes it incredibly dangerous. Basically, investors borrow money in a currency with rock-bottom interest rates, in this case the Japanese yen. They take that cheaply borrowed money and use it to buy high-yielding assets around the world, and they just pocket the spread between the low borrowing costs and the high return.
It's like taking out a massive cash advance on a credit card that charges 0% interest and putting all that cash into a savings account that pays 5%. As long as the interest rates don't change, you're basically printing free money. But there is a massive currency risk layered on top of that, isn't there?
Absolutely. The whole trade relies on the Japanese yen staying weak or stable. And right now, global central banks are inadvertently locking that dynamic in place.
Oh, so?
Well, on April 27th, the Bank of Japan held their interest rates at a microscopic 0.75%, citing the disinflationary effects of the geopolitical conflict. And then today, April 29th, the U.S. Federal Reserve is expected to hold their rates high at 3.75%.
So the interest rate gap between the U.S. and Japan is massive, and it's staying wide open. And because of that, the exchange rate, USD to JPY, has silently weakened to a 159.38. Investors are piling into this trade because the yield differential is just so tempting.
And the danger is compounded by a total lack of safe alternatives right now. BlackRock noted in their data this week that U.S. Treasuries are no longer providing their traditional buffer against equity declines. Furthermore, gold has proven to be a pretty ineffective diversifier during the specific flow of the conflict. So with traditional safe havens failing to protect portfolios, residual global liquidity is just aggressively piling into the yen carry trade to chase returns.
Okay, let's explore the unwind mechanism here, because the dispatch flags this as a ticking clock. If I'm an investor heavily leveraged in this trade, what actually forces me to blow up?
The unwind is essentially a massive global margin call. If inflation spikes in Japan or the Bank of Japan is suddenly forced to raise rates to defend their currency, the yen begins to strengthen really rapidly.
So going back to the credit card analogy, it's like the bank suddenly changes the terms on that 0% credit card and demands a 20% principal payment immediately.
Exactly. And because the investor doesn't have the spare cash just sitting around, they are forced to aggressively sell off the assets they bought. They have to liquidate their high-yield Mexican bonds, their emerging market equities, their U.S. tech stocks, just to get the cash to pay back the yen they borrowed.
And because everyone is caught in the same trade, everyone hits the sell button at the exact same time. the liquidity dries up instantly. That is why the historical context the source provides is so terrifying. Historically, yen carry unwinds happen without any warning. There is no slow deceleration. The currency snaps, the margin calls hit, and it transmits instantaneously into global contagion, hitting emerging markets the hardest.
Which really makes the final section of this dispatch vital for understanding the full picture. If you look at the surface level reporting right now, emerging markets appear to be doing fantastically well. It feels like a paradox.
It really does. I mean, the broad market data from BlackRock, Goldman Sachs, and JP Morgan shows the MSCI Emerging Market Index is up over 15% this month alone.
Yeah.
And the JP Morgan EMBI index, which tracks emerging market bonds, has actually tightened from 289 to 246 basis points.
Yeah.
And tightening spreads mean investors perceive less risk. So how can we have 40% oil flow disruptions, India facing a compound shock, a highly leveraged yen carry trade, and yet the emerging market index is up 15%?
Well, the dispatch reveals that this aggregate rally is a compositional illusion. It all comes down to how these major indexes are constructed mathematically. They are cap-weighted, meaning the largest economies completely dictate the direction of the entire index.
So the index is essentially graded on a curve, and the top two students are...
We're skewing the average so much that it hides the fact that the rest of the class is failing.
Wow. So who are the top students?
It's a very narrow set of winners. First, you have Asian countries like South Korea, which are manufacturing the critical semiconductor hardware for the AI boom. They are surging. Second, you have Latin American countries like Brazil, which export energy and commodities. They are actively benefiting from the high oil prices.
Got it. They're massive economies, so their success drags the composite index upward, completely masking the pain of the countries being left behind.
Exactly. And the source starkly contrasts these winners with the energy-importing frontier sovereigns in Asia and sub-Saharan Africa. For these smaller developing nations, a sustained 105 oil price doesn't just result in a bad quarter for corporate earnings.
Right.
It inflicts deep structural damage. It drains their national currency reserves, spikes their import bills, and destroys their fiscal accounts. They are absorbing massive compounding stress. But because their economies represent such a tiny percentage of the aggregate index, the broader emerging market dashboard still looks green and healthy.
It is the ultimate mirage. I mean, the consensus narrative on Wall Street is that the ceasefire reopened the global recovery trade. But at the sovereign credit level, for those frontier nations, the reality is a slow-motion collapse.
And the dispatcher draws very specific tactical conclusions from this illusion. They recommend overweighting Latin American hard currency commodity exporters. However, they really emphasize recognizing this for what it is. It's a tactical carry trade driven by an ongoing energy shock, not a structural upgrade in those countries' long-term economic fundamentals.
So they're staying extremely cautious on India and avoiding any exposure to that yen-funded EM carry trade we dissected. Instead, they prefer short-dated emerging market hard currency credit, especially as the U.S. dollar continues to gain strength. I think the DXY index was up 0.44% this week.
Yeah. It is a defensive, highly targeted strategy. It recognizes that the aggregate index numbers are mathematically accurate, but fundamentally lying to you about the actual distribution of risk.
Taking all of this in, from the conflicting bank desks to the hidden structural damage in emerging markets, relying on a single optimistic headline or a composite index average is incredibly dangerous. The certainty currently priced into the equity markets, this belief that AI fixes everything and a political pause solved the physical oil crisis, that certainty is the most expensive, vulnerable position an investor can hold while these dynamic multiplayer conflicts are actively compounding.
And at the very end of the dispatch, there's a brief, almost passing mention of Pakistan's bilateral creditor architecture eroding. It's a really quiet detail, but it raises a profound question. If the global market continues to look the other way, mesmerized by the artificial intelligence gains in the S&P 500 and the rising EM averages, what happens when the underlying creditor architecture for these completely ignored, energy-starved frontier nations quietly snaps?
Could the very act of the market ignoring the pain be the catalyst that turns a localized debt crisis in a small frontier market into a systemic global margin call?
It is entirely possible. When the system ignores localized pain to maintain aggregate euphoria, the eventual correction is never localized.
It all comes right back to the cockpit. The feeling in the cabin is a smooth ride to all-time highs. But if you force yourself to look at the instruments, the 40% oil flow, the $105 Brent crude, the tightening margin of the yen carry trade, the compound shocks hitting the developing world, the dials are telling a completely different story. You have to decide if you're going to trust the feeling of the composite index or the raw math of the underlying reality. Thank you for joining us on this deep dive into the Sovereign Dispatcher. Keep questioning the consensus, keep reading the instruments, and we'll see you next time.